Hey guys, how's it going? It's Andy from Magoo Investing. Happy Wednesday. Yes, I am wearing a hat. This is my second channel and I can do whatever I want, and I desperately need to go get a haircut, and I just haven't done that yet. One of the most common questions that I get is, when should I be buying into the overall stock market? And we get the situation where people are waiting for the perfect opportunity when, in general, it's better to just be involved with the stock market for longer than trying to time it. So in today's video, we're going to be talking about one of my favorite strategies that I tell my friends, especially the newer investors, for how to succeed in the stock market without having to worry about, watching the market every day. I can sit here every day and watch the stock market because that's something that I really enjoy, and I make YouTube videos on a regular basis, so it's important for me to see what's going on with the overall market. But for most people, they don't check the stock market every day. So since I'm waiting for the overall stock market, I have around 40% of my portfolio sitting in cash right now, waiting for a good opportunity to buy in and buy some of my favorite stocks at a discount. But for the rest of people, like 95% of the investing community, this is a strategy that I would recommend because I think it allows people to get the most amount of success out of their portfolio without having to worry about the emotional responses of waiting to buy in. So in today's video, we're going to be talking about the difference between lump sum investing and dollar cost averaging. They're two of the most common strategies that you'll see out there in the stock market, but I'm going to advocate for one over the other because I think there are some really strong benefits of using one. So let's talk about that in today's video. So one of the most famous investing quotes out there is the inspiration for today's video. Time in the market always beats trying to time the market. And this makes a lot of sense because the idea is that consistency is the easiest way to succeed in the overall stock market, because if you're waiting for this perfect opportunity that never comes, you're going to be missing out on the longest bull run in the history of the stock market. Yes, we did have the shortest bear market, but the stock market has just been chugging along. So trying to time it and wait for the perfect opportunity, you're going to spend more time on the sidelines than you are actually invested in the stock market, and that is not how you succeed in the long run. And for a lot of people, the strategy that they use is they save up a bunch of money, they realize, oh, I have too much money sitting around, I should invest it, and they put it all into the stock market at the same time. And this is called lump sum investing. And for someone like myself, this is pretty common, especially as we get around towards tax season when you need to contribute to your retirement accounts for the past year. And so you get a lot of money added to your account, and then it's just kind of sitting there waiting. And so this is fine for some types of scenarios, but for a new investor, it's usually the problem of deciding what to do with that money once it gets put in there, because there's the emotional response of losing money in the overall stock market. And if you put in, $1,000 at a time, and that's a lot of money for you, it's going to be pretty jarring to see, maybe I'm down like $50 in a single day. That would be pretty jarring for people overall. So instead of having to worry about that emotional response, they just don't do anything, and their money just sits in their portfolio because they're worried about buying in and losing money. So I think there's a better strategy out there, and I think 95% of people would benefit from using this strategy. And it's the idea of dollar cost averaging. Dollar cost averaging is the idea of spreading out your investments to a set plan of companies and in regular intervals. And the regular intervals is a very important part of it because I've used dollar cost averaging as a phrase in some incorrect areas. On regular intervals is actually very important to the idea of dollar cost averaging. So if you watched my video from January where I talked about how I would start over investing in the overall stock market, I picked 4 of my favorite stocks overall. I picked Microsoft, Apple, Adobe, and Nike. And instead of picking the stocks that I like the most, I could use the strategy of dollar cost averaging. And the idea of it is, in the first month, maybe I would invest $100. And instead of having to decide which one I like the most, I'm going to give them the equal weighting. So each of them will be 25% of my portfolio. And since we're at the point now where the stock market is the most accessible it's ever been, and you can buy fractional shares, I could split that up into $25 towards each of these companies. And allows me to get exposure to 4 of my favorite companies without having to make the tough decision of, which one is going to be better in the long run, which one is at a better discount at this point. And instead, you just throw all of your money spread out evenly across your favorite companies. And then the next month, I will invest another $100, and I will continue to use the same plan of splitting up that $100 into my favorite companies. And the whole idea is that it lowers the overall volatility of buying into a stock, because it sucks when you buy into a stock and then it falls like 5% like the day after you buy it. But if you're going to be dollar cost averaging and continuing to buy on a regular basis, you're going to be lowering your average cost, and allows you to consistently add to your portfolio size over time, and allows you to limit some of the volatility because you're going to be lowering your average cost if the stock market has fallen since your initial purchase. And since I'm only buying stocks that have fantastic track records, for the most part, they are going to be recovering. And so it allows me to lower my cost on a company that has seen an incredible track record and has always bounced back from tough market conditions or a tough sell-off from maybe a bad earnings report. So I'm not worried about that overall. But let's talk about both situations that can happen with dollar cost averaging, because I think it's really important to understand what are the results of this type of strategy. Because for a lump sum investing, you have the benefit of you get all of your money in at one time. And if the stock market continues to go up, you're going to be making a lot of money. But the part that isn't as fun to think about is with lump sum investing, if the stock market falls, you've put all of your buying power in at one time, and now you just have to sit there and wait for it to return to the level that you bought it at. And so there's two different situations. You have the fun situation for dollar cost averaging where the stock goes up. And since you bought in, the value of your shares have gone up. But then as you buy, you're increasing your position and it actually raises your overall cost. But the idea is that you're buying companies that you love, so you don't really mind what type of price you're getting. It's just the idea of consistently adding to your portfolio over time and increasing your size. And so that's the benefit of dollar cost averaging is you're just going to consistently be buying and you're not really worried about, is this a good deal? You're just going to keep buying. And eventually you're going to have a very large portfolio if you consistently do this, especially if you're picking winners that have done incredibly well over the stock market's history. And so the type of companies I would love doing this with are the blue chip stocks that have been incredibly consistent. And the blue chip is just the title that's given to these companies that have been around for a long time and they're industry leaders. Think about the companies I've already mentioned, Apple, Microsoft, Amazon, Google. These companies that are very dominant at the industry that they're a part of and they're relatively stable. And then what happens if the stock has fallen since your first purchase? Well, the idea is that you're buying more shares and you're lowering your average cost. So instead of the lump sum investing, say I buy a company at $100 and then it falls down to $90, well, that sucks. I'm down 10% and I'm just going to have to wait until it gets back up to $100. But in this scenario with dollar cost averaging, if it goes from 100 to 90, I'm going to be buying more shares. And since I'm going to be putting an equal amount of money in, my average cost is going to fall down to $95. And so this is the benefit of dollar cost averaging is you get the benefit of increasing your position size consistently, and you're going to be lowering your average cost if the stock has fallen. So now your average cost is much lower than it was if you used lump sum investing. The only problems that you can really have with this if you're doing this with a company that you don't plan on holding for the long term, because we do have some downturns that take more than a year to recover. And so if you're going to be doing some short-term investing, maybe dollar cost averaging isn't the best scenario out there. But for people like myself that are investing for retirement, I think this is a fantastic strategy to use. And I think the strategy is great for just one simple reason is it gets people to frequently invest in the stock market. You get this paralysis by analysis where you're looking for the best opportunities, and then most of the friends that I talk to, they just end up keeping the money in their portfolio and it's not doing anything. And that's such a waste because the stock market has been incredibly successful for the past decade plus at this point. And one of the best ways to get started is by taking away the friction and the decision making. And so you get rid of the friction because you've already determined how much money you're going to be putting in, and that's going to vary depending on your financial situation. But having a dollar amount set up every month, every 2 weeks, every week, that you're going to be investing and then putting it split up evenly into your favorite companies, it gets rid of a lot of the friction that you would have with, maybe my type of investing where I need to look for, stocks that have fallen recently and I have to decide where I want my money allocated instead of just, pushing them off to all my favorite stocks. And if you use this strategy, you don't have to only use this strategy. You have the scenario where maybe the stock market falls 20% and we go into a bear market. That is a fantastic buying opportunity. And so if you have money sitting on the side already that maybe you've just been saving up, that's a great time to throw it at the overall stock market because stock market crashes aren't as rare as we'd like them to be. On average, they happen every couple years, every 3.6 years actually. And so you get some fantastic buying opportunities. And so dollar cost averaging kind of limits the overall volatility, but if you see a fantastic deal in the stock market that you don't get very often, lump sum investing is a great opportunity. But for the long run, using dollar cost averaging for the good years and then using lump sum investing for the bad years is my go-to strategy. I think it's a fantastic way to build wealth over the long term. And so it's just the idea that bear markets and stock market crashes are jarring, and there's an emotional response that you have to losing, on average, a bear market goes down 36%. But then the following bull market, on average, for the entirety of the stock market, the returns have averaged 112% during those bull markets. So it's an important idea of trying to buy when the stock market falls, but for the most part, we've had some incredibly long bull runs in the past decades. And so being able to take advantage of that with dollar cost averaging, continuing to add to your position size, and then potentially using lump sum investing if we see a major market sell-off, I think is the best strategy to use for new investors. So thanks for watching this video. I appreciate all the support, and I will see you next time.